Earnings per share. Another very important topic. Again, part of section A. And again, this is more about accounting. There are two kinds of, first of all, when we talk about earnings per share, you need to understand we are only talking about earnings per common share, equity share. We are not talking about earnings per preferred stock. No. EPS or earnings per share is only calculated for common stock or equity shares. There are two kinds of EPS and both are there in your syllabus. Basic EPS and diluted EPS. Now remember, GAAP says this, and this is the rule. Accounts are generally bound by rules. GAAP says that both for listed companies, that is companies that are listed with the SEC, same thing our Indian accounting standards also says, and same thing IFRS also says, that for listed companies, both basic and diluted EPS has to be presented on the face of the income statement. What does face of the income statement means? Right on the income statement, P&L account, at the bottom half you will have to write basic EPS and diluted EPS. No exception to this rule whatsoever. Now what is basic EPS? Basic EPS says, see, you start with net income or PAT as we call it. Generally for numerator we say it should be net income attributable to equity or common shareholders. Divided by weighted average number of common, that is equity stocks. So basic EPS is always net income that you can directly attribute to equity shareholders, and you divide it by a specific term, not the number of common stocks. We are talking about weighted average number of common stocks, that is equity shares, outstanding during the year. This entire terminology completes the same. There are three phrases we use when we talk about common stocks. First is number of shares authorized or authorized shares. Authorized share simply means number of shares or maximum number of shares ideally. Number of shares should not be the word. Maximum number of shares that the company can legally issue. You have taken this much permission, you can issue this many shares. Nobody can stop you. Does this mean company cannot issue more shares than this? No. Company can issue more shares than this. They will have to amend their MOA and get approval again from shareholders. See, companies, nobody, when they start their company, Mr. Dhirubhai Ambani would have never thought Reliance would become a 20-30 lakh crore giant. So of course you keep on issuing shares, but so you can just amend your, in India we call it memorandum of association. In US they call it corporate charter. So you are free to amend that. But when you want to issue more than your authorized shares, you have to go back to the shareholders and ask for their permission. Second is issued stock. This is the number of shares that are actually issued by the company. This is the max. What is the limit? Authorized shares. You cannot issue more than that. And third is outstanding stock. We generally say this is the number of shares that is outstanding in the hands of, this is a layman's language, outside shareholders. Now listen and understand where does the difference is created. So let's say a company has an authorized share capital of 50,000 shares. Company actually issued 35,000 shares. The definition is very crystal clear if you focus on it. Authorized shares is the maximum number of shares that the company can legally issue. And issued shares is the number of shares that are actually issued by the company. Outstanding stock, on the other hand, is number of shares that is outstanding in the hands of outside shareholders. So in this case, let's assume outstanding share capital. See, this is the term used in your EPS formula. So let's say outstanding share capital is 32,000 shares. So issued 35, authorized 50, outstanding 32. 32 is what I will take. But the fact is, why will there be a difference between issued share capital and outstanding share capital? Treasury stock. Treasury stock. These are stocks and they don't need to tell you this. You need to understand because these are stocks. Company is holding these stocks in their own name. They are repurchased but not cancelled. In India, when you buy back the shares, you have to cancel it. In US and most of the Western European economies, you can hold treasury stocks and maybe resell it in the market later. So generally there can be a difference. There is a lot of times difference when you go and read a balance sheet between issued share capital and outstanding share capital. And if you look at this, we need weighted average number of outstanding stocks during the year. We don't need issued, we don't need authorized. So you have to be very clear with this. All right, please note it down till here. To see how this works, two examples, max 3, and everything will be covered. So example 1. So let's say there is a company and they provide us following details of events that happened throughout the year. They are giving so let's have date and particulars. Okay. So on 1st of Jan 24, let's say a company has opening number of shares outstanding. 20,000. On 1st of March, this company goes ahead in the market and issues 8,000 new shares. On 1st of July, the company repurchased 2,500 shares, which were held as treasury stock. This is a very important point because this tells you that the shares were not cancelled. And this is allowed in US and all major Western European countries. And let's say on 1st of October 24 again, the company issued or reissued. See, you can also, this is not part of your syllabus, part 1 it's covered, that they can resell these treasury shares also. But let's say they issued 2,000 new shares. Now, what am I talking about? I am talking about only here computation of weighted average number of shares outstanding. Now focus on the calculation, please, because I'll only have 2 examples here. More or less it covers everything. Then we'll cover while solving multiple choice questions. Let's understand. On 1st of January, the company had 20,000 shares. The screen is clearly visible to you, right? I can zoom it maybe a little more. 20,000. Now these shares were outstanding for the entire 12 months. So weight assigned to it, if you understand, in the numerator you keep number of months they were remaining in the financial year divided by 12. So this was there for the entire year. So in the outer column also you will have 20,000 only. In the second, that is 1st of March, the company issued, sold new shares in the market. Now, if you see weight, these shares were issued on 1st of March. Jan, Feb was already gone. So how many months are remaining? 10. So these shares were outstanding for only 10 out of the 12 months. That is, hmm? Hmm. 6,667, I think. Calculate it once. Hmm. Yeah. On 1st of January, company repurchased. Always remember repurchased. We always try to put it in like bracket so that to show that it should be subtracted from the calculation. On 1st of January means they were not outstanding. See, for others, we are talking about how many months were they outstanding. Here we are talking about how many months were they not outstanding. 6 months out of the 12. So it is, and on 1st of October, the company has issued 2,000 new shares. Again, they were outstanding for only 3 years. So what is the total in the final column? Of shares that will go in your weighted average calculation, EPS. See, the actual number of shares outstanding will be 20 plus 8 minus 2 plus 2, that is 28. This is what the balance sheet will show, the number of shares outstanding. But the number of shares that will be used for EPS calculation, that is weighted average, will be, and this is only relevant for EPS calculation. For no other place will this be relevant. Only relevant for EPS calculation 26,167. Are we clear? Note it down, ma'am. Now this is the easy. Now there are some. One is stock split. One is reverse stock split. And one is stock dividend. Stock split generally means, so let's say X Limited has 10,000 shares outstanding and went for a stock split apology for the interruption. Company went for a stock split of 4:1. Now, of course, I will first explain to you the accounting perspective. That means for every one share, 4 new shares will be issued. For every one old share in the layman's language. That means old shares cross. You will ask the shareholder that do one thing, you submit me your one old share, and against that I will give you 4 new shares. That is why it's called stock split, because out of the same stock, it is splitting up into new stocks. Now, what will happen as a result of this? In C, this is just a book entry. This does not have any effect on the actual books of the company. So 10,000 shares will become 40,000 shares. Because 10,000 shares shareholders will give, we will give them 40,000 shares. And because total par value cannot change. Earlier, what was the total par value? 10,000 into 10. That was 100,000. So right now also par value has to be 100,000 only. So par value of each share has to reduce in such a way that total par value becomes 100. That will become 2.5. If you want to understand it from another perspective, 10 divided by 4. Done. Now, why does a company does stock split? Company goes for a stock split. See, every country stock exchange generally has a liquidity range. When a stock price moves above that liquidity range, generally trading in the stock reduces. Like MRF in India, price is I think 1,40,50,000. Nobody can trade too much in those stocks. And if the trading halts, buying and selling halts or reduces. And that also affects the price of the stocks, because you want your stocks to be highly liquid. Then only people will be interested to buy them. So this is generally done to bring the stock prices down. Please understand, if the market price of the share in India, we say generally anything between 1,000 to chalo max 3,000, 3,500 is still liquid. But let's say if the market price of the share before stock split, I'll give you one good example. Nestle India. 3 years back, the share prices had reached almost 25,000, way out of the liquidity range. Way out of the liquidity range. They did a 1:10, a 10:1 stock split. So for every old one share, they issued 10 new. Now, theoretically, nothing has happened. Par value is shaved. So theoretically, price should also fall by exactly 10 times. So ideally, price should become, but markets are not perfect. So price may be a little more than 2,500, maybe 2,500 something, a little less. This is why stock split is carried out by companies. Then you have reverse stock split. It is the opposite of stock split. See the name also, reverse. Same example. X Limited has 10,000 shares outstanding and issued with a par value of $10. Company went for a reverse stock split of 4:1. That means for everyone, for every 4 old shares, company will issue one new share. Here number of shares will decrease. It's opposite. It's like you're consolidating, merger. That's why we are calling it reverse. So in this case, instead of 10,000, new shares will only be 2,500. And par value will increase. Always remember, par value will increase and will become 4 times, in this case, $1.40. But if you can just remember that par value just before stock split or reverse stock split and after reverse stock split and stock split will be exactly same, because this is a book entry. In books, nothing is changing. So you can find out the new par value very easy. Otherwise, common sense is enough. Why is this done? To increase the share. Maybe your stock prices have fallen way below the range. Maybe stock price has become 50 rupees or 30 rupees. And markets think it's a nonsense stock, penny stock as they call it. So management may want to increase the share price. So they are doing it. So let's say if market price per share before reverse stock split was 500 and you did a 4:1. In that case, market price after reverse stock split should become 2,000. It should increase. Of course, markets are not perfect. Maybe a little more, maybe a little, because then shares will again fall in the trading category and liquidity. So they are just opposite. Third is stock dividend. Dividend means distribution of earnings. Is it clear, both of it? Dividend means distribution of earnings of the company. Now the thing is, instead of giving dividends in cash, you may give dividends in stock. And shareholders may accept this if it is a growing company, growth, dividend policy, because they may accept the capital gains in the future. Again, theoretically, you're doing nothing. But there is one difference from stock split and reverse stock split. Dividend is always issued out of retained earnings. So let's say a 1:1, same thing. It's like bonus shares, what we learn in India. Company went for a stock dividend, and it can be any ratio. So let's say 4:1 only. That means for every one old share, or for, well, not old, for every one share, shareholder will get 4 new shares free of cost. 4 new, again wrong word, additional shares free of cost, because dividend free. So now let's say Mr. Ram earlier had 200 shares. Now he will have 200 plus for everyone 4 new. So for 200, 1000. The only difference, this will be issued out of retained earnings. So par value will not change. In this case, earlier it was 10,010, right? Correct? Now what it will become? It will become 10,000 and they will get 4 new shares or additional shares. So 10,000 plus 40,000 and par value will also not change. Because this is a dividend, money will be coming out from retained. So you do retained earnings debit, share capital, credit. Of course, small stock dividend, large stock dividend, price and all. But for now, you can just understand basically. So you will reduce this $4 lakh from retained earnings and transfer it to share capital account. Price same effect, because fundamentally nothing in the company is changing, that price should adjust. So again, many companies take this route also. You know why? Because in most of the countries, there is a legal limit below which par value cannot fall. Like in India, it is 1 rupee. And many companies in India are now sitting at that 1 rupee range. Number of years they have done stock split. So now they will issue stock dividend. Because stock dividend par value is not reducing. Instead of giving them cash, you are giving them dividend. But price will fall again. I think again, if I am not wrong, here I am, I think, failing. My memory is not serving me correctly, but again, I think Nestle only. After doing this 10:1 stock split, I told you, right? Somewhere 3 years back, the price was 26,000 or 25. They did a 10:1 stock split, if my memory serves me correct. Yeah, it was stock split only, not dividend. Price fell to almost 2,600. Last year or last year, they did a 1:2 stock dividend. For every 2 shares, they gave 1 share free of cost to reduce price further. So if it is 1:2 stock dividend, that means for every 2 shares held, you will get 1 share free of cost. So price should fall. So market price, if it was 2,600, it should fall by 2 or half. In a world, ideal world, it should be 1,300. Again, markets are not perfect. It can be little more or little less than 1,300. Are we clear till here? Note it down quickly. From here, you have to note it down, right? Now the rule is very simple. It says, in case of any stock split, stock dividend, or reverse stock split, we always adjust it to the beginning of earliest period presented for comparative reporting purpose. We will continue the discussion in the next class. Thank you.